Good morning, it's Jeffrey Christian of CPM Group. It's 7:50 in the morning on Tuesday, August 20th here in New York. The gold prices touched a new record of $2,564.60 this morning. It's off a couple dollars from that. Silver got as high as $29.86, 87 this morning. It's obviously pushing toward 30. I should point out that the gold price that we're using is the nearby active December COMEX futures contract. Spot prices are lower than that. Got several topics I want to talk about today. I want to talk about interest rates and the interest rate euphoria that is pushing not only precious metals prices higher, but other assets. Platinum, palladium, and copper were all up significantly this morning too. Markets have been flopping around, but we'll get into that later when I talk about the gold and silver market outlook. Talk a little bit about interest rates, a little bit about economic conditions. I think I want to start a new process here and throw in little historical or current pieces of information that probably are very relevant to investing in gold and silver and other assets that often are seemingly overlooked in the broader markets. And I'm going to start today with a little bit of gold history, talk about the market's outlook, and then the responses to a couple comments that I felt probably warranted some sort of response. This is the Fed funds rate, and you can see it has risen from 25 basis points to 5.25, 5.5. The preponderance of the market expects interest rates to fall in September when the FOMC meets in 17th to 18th of September. Most people, 74% yesterday, were thinking 25 basis point. There were another 20 some odd percent that thought that it might go 50%. There's been a tremendous amount of euphoria, which I think is heavily misplaced, about the idea of lower interest rates. We've said repeatedly in these videos and in our reports, watch out for what you wish for, because lower interest rates will signal that the Fed is extremely worried about the economic outlook. The Fed won't lower interest rates if everything's going well. By the way, I wanted to point out on this chart, because you hear people talk about how the Fed has never increased interest rates this fast, this far in history. And that's not true. It's not the steepest or largest by a wide margin. If you go back to 1980, you can see a couple times when interest rates were raised very sharply, and they were raised from much higher levels. They went from 10% to 20%, and then back down, and then they went to 22% or 23%, and then back down. So those obviously were related to Paul Volcker's killing inflation, and it also threw the U.S. economy into what was at the time the deepest recession since World War II. But if you look at 1985, you'll see a couple instances, once in 1985, once in December of 1986, where the Fed funds rate rose sharply. In December of 1986, the Fed funds rate went from 6% to 14.7% in 1 month. That's more than 5%. In 1985, they also rose very sharply over the period of like 1 month or maybe 2 months back then. And in neither instance did they throw the economy into a recession. And they were from much higher levels than we are today. The base from which these spikes started was significantly higher than the 5.5% Fed funds range that we have in place right now. I don't know if people who keep talking about the terror of high interest rates and how high interest rates are going to throw us into a recession, and how the Fed has never raised interest rates so steeply in history, I don't know if they even care to look at a chart. The most superficial analysis is to look at a chart and say, oh, there are outsized periods of time in the past when interest rates have risen sharply. What did that do to the economy? Well, sometimes it contributed to a deep recession, and other times it contributed to not having a recession. I should say that double dip recession in 1980, 1981, I started, and a lot of other people started thinking that we'd see a recession in 1979 or 1980. Back in 1978, in late 1978, my expectation was that we'd see a recession in 1979. I was off by a year. But the point is that Paul Volcker wasn't even Federal Reserve Board chairman in late 1978. There were other factors in the economy, in the real economy, and a surge to $58 billion deficit under Jimmy Carter. American hostages had not been taken yet. There were a lot of factors that suggested to a lot of people that we'd see a recession within the next 24 months in 1978. Paul Volcker came along. Jimmy Carter was very brave to appoint him Fed chairman in October 1979 with the mandate to kill 14% inflation. He said, I'll throw the country into a recession. And Jimmy said, I think we have to do that. If that's the byproduct of curing the high and volatile inflation that we have in the 70s, that's the pill we have to swallow. Partly cost him the election in 1980, but that's what he did because he was a president as opposed to a politician. So I don't know where commentators get their analysis, but it's clearly not from even looking at a chart of federal funds rate, much less studying it. This is the 10-year Treasury rate. As with the Fed funds rate, we saw it come down for many years. It bottomed out. It has risen, and it's been at a plateau. It's come off a little bit from its high. Expectations are that the Fed funds rate will be reduced next month. Those expectations are probably accurate, but they're probably also overblown. And the consequences of them are not clear. You cannot say that we're headed to a recession or that we're headed to a soft landing with any degree of certainty. The economic environment, the real supply and demand of goods and services is very mixed picture right now. And the future of fiscal policies, spending and deficits and taking on debt is also very much unclear now, not only in the United States, but on a global basis. I showed you this chart last week. This is historical U.S. GDP, and I made the point that the U.S. economy has been less volatile since World War II than it was prior to that. We had a series of depressions over 30 years in the 19th century. We had the Great Depression prior to World War II. We have seen a less volatile economic environment since that time for a variety of reasons I won't bore you with. But I wanted to put this in here because I wanted to also show you quarterly real GDP figures, because it reveals things that the annual data in the previous chart miss. And I put circles around the recession in 1990 and the recession in 2001, 1991 and 2001. Short, shallow recessions preceded, we had a recession that ended in late 1982. We had 9 years between that recession and the next one in 1991. Then we had 10 years between the 1991 recession and the 2001 recession. So you had longer periods of economic expansion, and you had shorter, shallower recessions in those two instances. You also notice viscerally that the GDP growth during those expansion periods was less than it had been prior to 1980. So we forewent some economic growth potential in order to keep inflation down. And inflation went from 14% in 1980 to 5% or so by 1983, 1984, and then down to 1 to 2% for a long period of time until 2021. So we gave up some of that growth in order to keep inflation down. and prices down over that 20 some odd year period. That lasted until the Great Recession and global financial crisis in 2007, 2011. Coming out of that, even lower growth during the expansion, the COVID lockdown, the economic recovery after that, which led to the higher period of inflation, which is where we are now. But pay attention to how short and shallow recessions can be, because that's going to be important. Actual job creation in the United States, it's come off from the post-COVID lockdown period. It is higher still than it was for most of the period of time from 1999 until the present. There are a tremendous number of jobs being created in the United States, as well as in other parts of the world. CPI, we've seen that spike post-COVID. It's coming down. It's still high. It presents a real quandary for the country and for monetary policy, because while it is coming down, it's still high, and there are pockets of very persistent secular inflationary pressures, even as there are disinflationary and deflationary pressures in other parts of the economy. And that's going to continue to be the problem, regardless of what happens with monetary policy. Fiscal policy could change that and improve that balance, but that's highly unlikely given the composition of the political structure of the United States at this point. And this is the actual consumer price index level. This is what costs are. Because people they keep hearing politicians and others say, oh, inflation's coming down, but prices are still high. Yes, inflation is the increase in prices. Price levels are something completely different. We have a problem with a lot of things that are very expensive. A lot of that has to do with oligarchic pricing conditions across many sectors of the economy. It has to do with other economic dislocations and a lack of fiscal guidance on the part of Congress and the administration to the economy as to what we really need. Now, a bit of gold history. Like I said, I plan to start these videos with interesting facts, adding current and gold things. And I'm going to start with one fact about the 1933 suspension of gold ownership in the United States that's typically overlooked by the didacts that like to focus on that in a kind of weird, the word at the moment, fashion. In future videos, I have a couple other tidbits lined up. A secret meeting with a high-level U.S. official with Vladimir Putin many years ago, discussing how Putin and that officer thought the U.S. and Western cultures were barbaric and degenerate and needed to be replaced. Very interesting anecdote that came out in some investigative research reporting, followed by a congressional hearings. And then also the myth of the Saudi-U.S. petrodollar agreement of 1975. I'll talk about those in the future. I wanted to talk about 1933, and I've already talked about this a lot, so I'm not going to go fast. But by 1933, the U.S. Treasury had estimated it had issued about 58 million ounces of gold coins and certificates by the time we got into the Roosevelt administration. He was sworn into office in early March. He closed down the banks for about 5 days. When he reopened them, there were lines of people in front of banks across the country looking to redeposit their money that they had taken out of their bank account because of the conditions of the Great Depression and deflationary pressures at the time, and bought gold. And they were hoarding their money in gold, which was confounding the government's ability to get us out of the Depression. And at the time, gold represented about a third of private financial wealth. Today, it's about 0.6%, less than 1% of wealth. So when people talk about gold confiscation, they're nonsensical, because back then it was a third of the financial wealth. It was very important. Now it's inconsequential to monetary and fiscal policies. But everybody knew in early March that Roosevelt was going to call him to gold. 58 million ounces out there, we needed to do it. We saw individuals line up to put money back in the bank in early March after the inauguration. He didn't issue the Executive Order 6102 until April 5th. People knew it was coming, and 40 million ounces of gold were voluntarily turned into banks by the end of March 1933, before the decree was even issued. That's patriotism. That's Commonwealth. 40 million out of 58 million ounces were turned in before the decree. Another 4 million ounces in the first month following the decree by May 1st, and then another 2 million ounces in the 9 months after that because the program was extended. The Treasury reported there was about 8.2 million ounces of gold in coin form that was unaccounted for, that must have been exported or lost since it was not turned in. Much of that was actually legally retained by U.S. citizens under the terms of Executive Order 6102. And that's the key point I wanted to talk about. Right? The only person prosecuted for not turning in gold was a guy who wanted to make himself a martyr. And he published the fact that he would not comply, wanting the government to dare to prosecute him. So it did. There were no T-men or Treasury men or government officials going through people's houses or offices or bank deposits, security deposits, or anything else. The government said, hey, turn in your gold, but you can keep 2 ounces of gold coins from each year's mintage that we've made. The government had issued gold coins for 138 years. So if you had collected 2 gold coins from the beginning of the U.S. Mint until 1933, you could have owned up to 276 ounces of gold in gold coin form, legally, under the confiscation. That was worth about $5,000 in 1933, the price of a really nice house. And it was more than $9,000 once Roosevelt devalued the dollar starting in 1933. But a lot of people don't realize that when the government said, turn in your gold, said you can keep the 2 ounces of each year's mintage. Let's talk about gold today. Record prices, not surprising. We've been trading between 2,300 and 2,550 really for about 3 months now, since April. And our expectation is the price will continue to be volatile. There's this interest rate euphoria that's going on. Everyone wants to parse what's going to be said at the Jackson Hole, Kansas City Fed's Jackson Hole conference this Thursday, Friday, Saturday, and they will. I'm sure that the Fed is going to continue to say what it has been saying, and the Fed will continue to do what it has been saying, which is really what the Fed has been doing. That won't stop financial markets from being extremely nervous and euphoric. Like, will the Fed do this? Will they do it, ahead of time? Will they not do it? There are mixed economic data that's coming out, and the Fed is data-driven. It doesn't necessarily look at the stock market. It looks at employment, unemployment, overall economic conditions that factor into future trends in employment, and inflation. And some of those things are very worrisome, pointing toward a recession, and some of them are very worrisome, pointing to not a recession, but continued inflationary pressures. So the Fed has a tough balancing act, and it's a tough balancing act not knowing what fiscal policy is going to be going forward, given the presidential and congressional elections coming up in November. So gold's probably going to continue to flop around. Our short-term view is that there could be some post-interest rate cut down. The major negative that we see in the gold market right now is that most institutional investors seem to be about as fully loaded in the gold as possible. If economic and political conditions improve, let's say that there is a truce, an end of the bombing in Gaza by Israel, and if the Ukraine effort is not met by a devastating counteroffensive that the Russians are preparing with Belarus, let's say that things go better in Ukraine. Let's see that there's other factors that are going on politically that are good, and the economy continues to look like it is going to prosper the way it has, and maybe inflation continues to come down. Gold could come off. We think that there's a pretty solid base around 2,300 right now. It could spike below that depending on how things transpire over the next 6 months. But we do think that gold prices are probably headed to higher prices over the next 6 months rather than lower prices overall. So any pullback we would see as being a temporary pullback. Silver, similar situation. Silver's been weaker, but it has been trying to push up above $30. It was above $30 for much of May. June it went below $30, but it stayed pretty much above $28, $28.50, $29. It's come back up above $30 in early July, came back down below that in late July and August. It's pushing back up toward that. Our expectation is also that silver prices will rise more sharply over the next 6 months and over the next 24 months, 18 months or so. So that we do think that this is a period of consolidation that we're seeing in the silver market. Couple points. Rodney wrote, be good to others. Not quite what you did here. In my comments, laying out the professional backgrounds of Ted Butler and Andrew McGuire. You're wrong, Rodney. I was being good to people who are important to me. To you, and to others that I spend my time pointing out fraudsters and scams and misinformation to. I was being good to others. I can't help you if you look a gift horse in the mouth. If you don't do that, you might learn how to identify fraudsters and scammers. You might learn that conspiracy theories that do not make any sense or hold up to even the most superficial scrutiny. You might go to our website and visit the place where we have information where the CFTC has repeatedly studied the silver market and found no evidence of long-term ongoing manipulation or suppression of silver prices. They have found evidence that such a conspiracy does not exist, and they have found people who have spoofed the price, which has an effect on the price for 1 day, maybe 5 days. And more than half of those periods of time when spoofing may have occurred were designed to push the price higher rather than lower. We've done videos on this. They're on YouTube. You could look at them instead of whatever it is that you do in your days. But, I can lead you to the water, but I can't make you drink. Fraudsters, scammers, and pumpers have consistently been wrong in their pontifications and their price expectations and do this now because the world's about to collapse or the dollar's about to collapse or the BRICS are coming out with a gold-backed currency. Things that don't happen. And after some period of time, your spouse should say to you, Rodney, look at it. You've been taking this guy's advice for years or decades, and he's been consistently wrong, and we're living in a mobile home. I can help you, but you've got to learn to discriminate good information from bad. And I can't help you with that. You got to go back to grade school for that. Next one. How many times has JP Morgan been fined multiple millions of dollars for market manipulation? This is the Roger. Roger, I don't know. I'm pretty sure JP Morgan has never been fined millions of dollars for manipulating precious metals markets. It was fined millions of dollars and put under government oversight for several years for not adequately supervising fewer than 5 metals traders who were later convicted of spoofing the gold and silver markets. Right? In the trial, it came out that JP Morgan's management should have known these guys were doing that, but did not. And even the other traders on the metals desk did not know what the spoofers were doing. And I think 2 of the 5 people put on trial were acquitted because there was no evidence they actually were doing it. This is evidence of a lack of supervision. And it is evidence that there was no broader conspiracy to spoof or manipulate markets. J.P. Morgan didn't know what its traders were doing, let alone people at other banks. Right? There's no conspiracy here. It's people spoofing the markets, which people do everywhere, including the local grocery store. The same was true in Barclays' case several years ago, where a trader on the desk was trying to push the gold price in one direction on options expiry day because he didn't want his clients' options to come into the money and get exercised. He wanted them to expire worthless, in which case Barclays and he get to keep the premium. Others on the trading desk, including the guy who sat across from him, did not know what that one salesperson was doing. Barclays was fined an enormous amount of money for lack of supervision, lack of oversight, which is why banks today spend more money and hire more people in oversight and supervision and compliance than they do in trading. They're more concerned about, they're spending more money on protecting themselves from being accused and found guilty or innocent of doing inappropriate things than they are spending money on trying to hire units of output that could make money. And one last one. Come on. I said that Newt Gingrich in the mid-90s had created a further division in political parties. And this guy said, no, it's because the Democrats are socialists and communists. Well, look, if you think the Democratic Party is a socialist or communist party, you're so divorced from reality that you probably should not be participating in votes and in broader society. Clearly, you've never been to a communist nation. I have. Clearly, you've never talked to communist politicians. I have. Clearly, you never actually studied political systems. I have. I have in my Kindle Adam Smith's Wealth of Nations, Thorstein Veblen's Theory of the Leisure Class, and Karl Marx's Capital. I've read all of them. It's like more than 2,000 pages of really dense, 18th and 19th century writing. You clearly never understood communist systems. Your opinions contribute nothing to the common good. They distort and distract what should be an honest and informed common discussion for the commonweal. And don't take my word for it. Here's the link to a thing from The Hill. But if you search that, Newt Gingrich, did Newt Gingrich lead to the period of time when Newt said to the Republican Party when he was the Speaker of the House, we must not cooperate with the Democrats about anything, anywhere, anytime, anymore. And you find The Atlantic, The Hill, the New York Times, academic scholars have written about how Newt Gingrich really contributed to the economic paralyzation and governmental paralyzation that we have today. I don't know what you're doing. We can probably watch football. I'm reading Wealth of Nations. You can find more accurate, unbiased precious metals information at CPM Group. We have the Precious Metals Advisory. We have the Gold, Silver, Platinum yearbooks. They're all available on our website. The Precious Metals Advisory has short-term 3-month and intermediate-term 2-year quarterly projections for gold, silver, platinum, palladium, and rhodium. You can buy them individually. You can put them together in a package with some consulting services. You can go to CPM Group and read all about them. You can go to CPM Group and buy them, subscribe to them, and you can write us an email at info@cpmgroup.com. Rodney and everybody else, take care of yourself. Take care of people around you. Try to do good for the Commonwealth, for the world. And feel free to say, you know what, this guy's a scammer, and this guy's a fraud. Go to the internet. Compare our track record to anybody else's track record who's sitting there waving their arms and has been waving their arms for their entire career. If you go to Goldman Sachs and J. Aron, as various entities did in 2013, 2010, you'll find that they have records that I worked there. You'll find they don't have records that Andrew McGuire worked there. Now, one last thing, Rodney. I actually was nice to Andrew McGuire in outing him. See, in England, as in many other countries, it's not necessarily illegal to pretend you're something you're not. But in England, at least, if you try to become a money manager and you collect money from people on false pretense, saying that, hey, I was a trader and at a bullion bank. Trust me, I know these markets. The Bernie Madoff syndrome. If you hold yourself out to be something else while collecting investor money, then the Serious Fraud Office in England looks into you. And Andrew McGuire was weeks away from launching a gold money management program with a company in England when I made my speech at the Silver Summit. And after that speech, they revised their offering to take out any references of his past experience as a bullion banker at a major bullion bank. So I guess, in a way, I did good for him because he's still around. Take care of yourself, take care of others, be good to the world, do something good for the world or for somebody on the street, and I'll talk to you later on Friday.